3 months back, Patricia entered the office of a mortgage lender sporting a credit score of 621. The loan officer didn't surprise her with the expected outcome. She could secure a mortgage, yet the interest rate hovered near a daunting 7% on a 30-year loan. On a $350,000 property, this rate would saddle her with over $180,000 more in interest compared to a buyer with stellar credit. Patricia requested a 90-day window to boost her score before settling on the rate. The loan officer nodded courteously, but cautioned against expecting dramatic changes. Credit scores don't fluctuate swiftly. Just over 3 months later, Patricia returned with a score of 761. The loan officer questioned if she'd made an error with her social security number. But Patricia hadn't. She'd merely uncovered a well-kept secret embedded within the credit scoring system, something most consumers overlook, yet banks and credit card companies know but choose not to disclose. This revelation saved her more than $215,000 in lifetime interest on the same mortgage. The knowledge she uncovered wasn't a sneaky trick or loophole, but a legitimate feature in how credit scores are determined, conveniently concealed by the financial world. Today, I'll reveal Patricia's discovery to you. By video end, you'll recognize that while the slow, incremental credit building advice is technically accurate, it's practically misleading. A quicker method exists, yet it's unadvertised. Let me unfold why the typical credit score advice ensnares people longer than it should. Common guidance tells one to pay bills promptly, maintain low balances, limit new accounts, and simply wait. Wait for years, even decades. Allow your credit history to mature. In time, your score will soar into the excellent bracket. This isn't wrong, just incomplete in a way that financially benefits lenders. Every month spent in the fair or good credit zones rather than excellent costs you money. Higher interest on cards, unfavorable auto loan terms, increased mortgage rates, elevated insurance premiums in numerous states, and larger security deposits for rentals. The credit score tax weighs heaviest on those least able to bear it, with the drawn-out conventional route extracting this tax longer than needed. Banks thrive on this expanded timeline. Someone with a 680 rating who could be at 780 is more lucrative. They incur higher rates, generating more interest income. Helping them escape this bracket rapidly isn't in the bank's interest. The gap Patricia discovered is tied to authorized user trade lines. To grasp these, it's crucial to understand credit score computation. Your credit score predicts your likelihood to default on a debt in the next 2 years. The algorithm examines your credit history, comparing your behaviors to millions of others, identifying factors linked with defaults and factors indicative of responsible payments. The largest factor is payment history, making up about 35% of your score. The next significant factor is credit utilization, accounting for about 30%. Here's the twist. The third largest is the duration of your credit history, which factors in the oldest account age, newest account age, and average age of all accounts, making up roughly 15% of your score. Most presume credit history's length is purely time-based. You got your first card at 18, and now you're 30, so that's 12 years of history. Nothing actionable, just patience. But that assumption misses a trick. The loophole lies here. Becoming an authorized user on someone else's credit account means that account's entirety, history, payment record, credit limit, and usage gets mirrored on your credit profile as if you'd been on that account all along. If your mother owns a card opened 23 years back with flawless payments and low usage, adding you as an authorized user means that 23-year-old account will reflect on your credit immediately. Your average account age could leap from 2 to 12 years overnight. Your available credit might double or triple, and your longest account history could stretch back decades, just like Patricia's did. Patricia's mother held 3 credit cards with a total history exceeding 40 years, perfect payment records, and a utilization rate under 5%. Patricia was added as an authorized user on all accounts, and within 2 billing cycles, they appeared on her credit reports. Her previously sparse credit profile became substantial. Her brief history suddenly seemed well established, and her score leapt up by 140 points. While this strategy is well known in the credit industry, it's not widely advertised to the general public, largely because reducing the time people spend in high interest zones doesn't profit companies. Now, let me illustrate how this can apply in various situations. Marcus, at 24, faced a credit score of 589. College had seen him make some poor choices, missing several payments and maxing out a store card during a challenging semester. His attempts to secure financing for a used car led to dealers offering him interest rates above 14%. Marcus's grandfather, with cards dating back to 1987, presented a spotless history and limits totaling over $60,000, keeping utilization under 3%. By adding Marcus as an authorized user on his 2 oldest cards, without providing him physical access, the intervention was purely strategic. In just 60 days, Marcus's report reflected accounts with a 37-year flawless history. His average account age skyrocketed from 2 years to nearly 19, with available credit tripling. His score soared to 697, qualifying him for a reasonable auto loan rate of 6% compared to 14%, saving him almost $5,200 in interest on a $25,000 5-year loan. This quick move by his grandfather, completed in about 10 minutes online, instantly conferred decades of creditworthiness. Here's how you can execute this method effectively, as details are crucial. First, ensure you're added to an account in good standing, ideally one with a perfect payment record. Missed payments will do more harm than good. Keep utilization low, ideally below 10%. Older accounts are favorable. The credit limit should exceed the balance significantly. Second, the primary account owner must agree to add you, usually a family member or close friend, offering you their positive credit history, while trusting you won't misuse any card that might be provided. Often, people add authorized users without handing over an actual card. Third, not all issuers report authorized user accounts to all 3 major credit bureaus. Generally, large institutions like American Express, Chase, Bank of America, Capital One, and Discover include this data. Verify with smaller banks or credit unions before proceeding. Fourth, once added, the impact is typically visible within 1 or 2 billing cycles. There's no years-long wait, as the history is swiftly incorporated once reported. Lastly, you can be removed as an authorized user anytime, and the account will eventually drop from your report, rendering this a low-risk strategy for the primary account holder. The efficacy can vary based on your initial credit standing. A thin file with a short history benefits the most. Patricia originally had just 2 individual accounts under 3 years old. Introducing 3 more accounts with an average age of 14 years transformed her credit profile. Those with established records observe moderate but notable improvements. Increasing the average account age from 7 to 12 years could enhance the score by 20 to 30 points. Many might wonder if this practice is legitimate. The answer is unequivocally yes. The authorized user approach is intentionally built into credit scoring models like FICO and VantageScore. The practice is legal and officially acknowledged by credit bureaus. Initially designed to support spouses in credit building when one partner managed finances, it has expanded to allow parents to aid children and others to support one another when needed. Critics have occasionally argued that this constitutes a loophole, but it remains an accepted element reflecting true financial relationships. The credit industry has largely disregarded these suggestions due to the complications involved in altering the authorized user system, which could introduce further difficulties. As of now, this strategy is fully in place. However, it's important to recognize some constraints. Certain mortgage lenders examine authorized user accounts carefully during the underwriting process. They might not give these accounts full consideration, even if they're reflected in your credit score. This practice is more common with manual underwriting rather than automated systems. Luckily for Patricia, her lender used automated underwriting, which accepted her credit score as it was. Authorized user accounts are often given less significance than accounts where you're the primary holder in some scoring models. Over the years, FICO has adjusted its system to minimize the influence of accounts where you're not the main account holder. Although the impact remains considerable, it's less drastic than it was a decade ago. You're still reliant on how the primary account holder handles their credit. If they miss a payment or increase their debt, your score is affected. That's why choosing a trustworthy partner is paramount. Ideally, a relative with a long history of managing credit responsibly. Let me broaden the discussion beyond authorized users to other overlooked aspects of the credit system. A second loophole entails understanding precisely when your credit utilization is assessed and reported. Your utilization ratio, the portion of your available credit that you're using, constitutes nearly 30% of your score. Common advice is to keep this below 30%, but more refined strategies suggest staying under 10%. The best range is actually between 1% and 3%. What many don't realize is that utilization is based on the balance that gets reported to the credit bureaus, which usually occurs on your statement closing date, not your payment due date. You might clear your credit card each month, avoiding interest and using it wisely. However, if you charge $2,000 on a card with a $3,000 limit and that balance shows on your statement, you're displaying a 67% utilization rate. This affects your score even if you pay in full. The solution is straightforward. Reduce your balance before your statement closes, not just prior to the payment due date. If you lower your balance to $50 before the statement finalizes, your utilization reports at under 2%, potentially boosting your score by 20 to 40 points swiftly by simply adjusting your payment schedule. This timing tactic works within one billing cycle. You'll see the updated utilization on your credit report the next month if you pay before the statement closes this month. The third loophole involves credit limit increases and their surprisingly significant effect. Since utilization is a ratio, you can enhance it by either lowering your balances or by raising your credit limits. Most people focus on the balance part of the equation, often neglecting the limit aspect. Many credit card issuers, like American Express, offer credit limit increases without conducting a hard inquiry on your credit report. You can request an increase through their app or website, and they often approve substantial increases through a soft check that doesn't impact your score. Doubling your credit limit can instantly halve your utilization ratio. If you carry $2,000 on a $5,000 limit, representing a 40% utilization, increasing that limit to $10,000 reduces your utilization to 20% with no change in spending habits. Your score improves simply because the ratio has changed. Ideally, you should request increases from all your cards every 6 to 12 months. Each increase not only improves your utilization ratio, but also enhances your available credit metrics. Over several years, someone starting with $10,000 in total credit could amass over $50,000 in available limits just by routinely asking for increases. Banks seldom promote the option of requesting credit limit raises, as they prefer customers maintaining limits that ensure profitability while potentially qualifying for better rates elsewhere. The fourth loophole involves strategic management of accounts, which is often done incorrectly by most consumers. The common notion is that closing old accounts can harm your credit score, so they shouldn't be closed. While this is partially true, it's frequently misapplied. What really matters is your oldest account's age and the average age of your accounts. Closing a relatively new account might actually boost your average account age, while shutting down your oldest account would definitely have a negative effect. The strategic approach involves discerning which accounts are beneficial to keep and which can be closed without repercussions. That store card you opened 2 years ago for a 15% discount might be a candidate for closure if it's lowering your average account age and offering no real advantage. In contrast, even if your oldest credit card gets minimal use, it should stay open indefinitely. Many people hold on to all their accounts out of fear. They accumulate store cards and various accounts that complicate their finances without providing benefits. By thoughtfully analyzing which accounts to keep and which to close, you can actually enhance your score while simplifying your financial affairs. The fifth loophole involves something called rapid rescoring, a tool most consumers are unaware of. During a mortgage application, timing is crucial. Generally, improving your score through standard channels means changes take 1 or 2 billing cycles to reflect. However, rapid rescoring can adjust your score in a matter of days. Here's how it functions. Your mortgage lender can request that credit bureaus make immediate updates to specific items on your report, given the right documentation. For example, if you pay off a credit card balance and supply proof, the updated zero balance can be shown within 72 hours instead of waiting for the cycle to close. Rapid rescoring isn't something consumers can access directly. It's available only through a lender during an active mortgage application. Being aware of it allows you to time your credit optimization efforts strategically. Significant improvements should be made during or right before your mortgage process, so the effects remain impactful. This rapid rescoring window creates opportunities for substantial last-minute score enhancements. For instance, paying off a $5,000 balance mid-application can result in your score being updated before final approval. If you become an authorized user on a parent's account, that can reflect within days rather than weeks. By executing strategies combined with rapid rescoring, you can see score increases of 50 to 80 points during the application. Before presenting the action plan, let's discuss common mistakes that frequently undermine these strategies. The first mistake is selecting the wrong authorized user account. If an account has high utilization, it can do more harm than good. Similarly, any past mispayments on an account bring those negatives along with the positives. An account that's merely 3 years old offers minimal benefit if your current accounts are already that age. Carefully vet accounts before adding yourself. The second mistake is applying for new credit during this process. Each hard inquiry can temporarily drop your score by 5 to 10 points. Moreover, a new account reduces your average account age. Many people undermine their optimization progress by opening new accounts that counteract their efforts. The third mistake involves inconsistent timing of utilization management. Paying before the statement closes is only effective if done consistently. A single month of high reported utilization can negate months of diligent optimization. Set calendar reminders a few days before each statement closes. The fourth mistake is impatience. These strategies generally take 1 to 2 billing cycles, which can feel sluggish when you're anxious about an upcoming application. Some individuals abandon the approach before it appears on their reports. Trust the process and verify changes by checking your reports after 2 full billing cycles. Let me provide a detailed action plan for implementing these methods based on your current situation. If your credit score is below 650, the authorized user strategy presents the greatest potential impact. Find family members with aged accounts, stellar payment records, and high limits. Request to be added as an authorized user on 1 to 3 accounts. Simultaneously, dispute any incorrect negative items on your report through official channels. Pay down credit card balances to less than 10% of their limits before the next statement closes. For scores between 650 and 720, you're in the optimization range where numerous small adjustments can lead to significant gains. Ask for credit limit increases on all existing cards. Alter payment schedules to cut reported utilization. Consider the authorized user approach if you face issues with a thin file or short account history. Look for any outdated negative items that may qualify for removal based on goodwill, especially if you've maintained a good history with that creditor. If your score surpasses 720, you're generally in a good position, but optimization remains important for securing the best mortgage rates. Although the difference between 750 and 780 might seem minor, it equates to significantly varying interest rate offers. Focus on managing utilization timing, requesting limit increases, and sustaining the positive habits you've established. Regardless of your starting point, everyone should fetch free annual credit reports from all three bureaus and scrutinize them for mistakes. Studies repetitively indicate that a substantial portion of credit reports contain errors, some significant enough to influence scores and loan eligibility. Engaging with legitimate errors is a distinct process from the strategies I've outlined and should occur concurrently. There's a fundamental reality beneath these tactics that redefines how you should perceive credit scores. Originally, the credit scoring system was crafted by lenders to assess risk from their perspective. Its purpose wasn't to optimize your personal financial situation, it was to assist banks in determining your potential charges. The system selectively presents and conceals information in a manner that prioritizes institutional benefits rather than consumer interests. Banks don't highlight the authorized user strategy because it allows you to avoid their high interest offerings more swiftly. Credit bureaus refrain from emphasizing utilization timing due to its complexity, which keeps individuals reliant on credit monitoring services. The entire industry profits from the belief that credit enhancement is a prolonged, cryptic process necessitating patience and possible paid help. In truth, credit scoring adheres to specific mechanical rules. These rules can be deciphered and optimized. The disparity between those who grasp these rules and those who don't directly leads to wealth imbalances over time. A person maintaining a 780 score instead of a 680 score will incur significantly less interest over their lifetime. They'll enjoy reduced mortgage rates, lower auto loan rates, favorable credit card terms, and decreased insurance premiums, with savings that accumulate over decades. These strategies succeed because you're engaging with the system's genuine rules rather than the simplified narratives formed around them. You're not exploiting loopholes or taking advantage of flaws. You're utilizing inherent features designed deliberately, yet not disclosed by entities that profit from your lack of awareness. Patricia's 140-point increase in 93 days permanently altered her financial course. The $215,000 she'll save in mortgage interest will support her retirement. The insights she's acquired will guide every credit choice she makes going forward. That same insight is accessible to you now. The strategy isn't concealed due to illegality or unethicality. It's obscure because entities with vested interests don't gain from you knowing it. Now you are informed. How you choose to apply this knowledge is entirely in your hands.